Joining us now, Gary Cohn, IBM Vice Chairman, former Director of the National Economic Council, joins us on set, as he really should, exclusively, from time to time. Thank you.
Joe, it's always nice to be here with you.
Always good to see you.
What an introduction.
Yeah.
You saw, I don't.
Nice introduction.
It's not nice to be wanted. No, it's not. It's not nice to be wanted. Did I want you here instead of somewhere else? It's not. Would you rather say, gosh, I wish you were on another show? No, you wouldn't.
It's always good to be wanted.
And you were watching Langone, Ken, yesterday. And the Journal has never liked tariffs, obviously. Wall Street Journal, they're classic conservatives. Ken does not like tariffs. Mm-hmm. But there's a feeling among a lot of classic conservatives that something needed to be done, and they've kind of been lulled into the idea that some of this is okay, almost accepting some of the tariff moves. This kind of threw me a little bit today because it's the president wouldn't like the results of what happened in those numbers yesterday. They weren't horrible, but real weekly wages fell, adjusted for inflation because of where inflation was. So inflation's up, wages are down. That's not what he wants. It's not what he was elected to do, and it's a reflection in large part from some of the tariffs, right?
Correct.
What would you advise the president to do with tariffs at this point?
So look, I think you made two really important points.
Really?
Yeah, two. Yeah, it's pretty good start.
Wow. I'm going to have to go back and watch the tape. Go ahead.
So look, one point is there is a understanding or view in this country that we need to control certain parts of our essential supply chain. You know, I always say if COVID taught us nothing else, it surely taught us how vulnerable we are on essential parts of our supply chain. So the fact that we're trying to move some of our most vulnerable pieces of our supply chain that can shut down our U.S. economy and move them back to the United States. I think the vast majority of Americans and the vast majority of economists and the vast majority of business people all support that.
And that wouldn't have happened with pure market forces.
It would not have happened with pure market forces.
Okay.
So the good piece is we are starting to understand what are the essential things that need to be moved back to the United States
to
protect ourselves. It might cost us something.
Okay.
So that's the point that I think is interesting. The other point is, we are now at a point where we are collecting $30 to $40 billion of tariff revenue a month. And everyone's boasting about, the $30 to $40 billion of tariff revenue a month. The one thing I think we all will agree at is there's no free lunch. Someone's paying the $30 to $40 billion.
Yeah.
And ultimately, it is going to end up being the consumer that pays that money. So for a short period of time, maybe the business is eating it. So if you're an importer and you're Nike or you're Apple, you may be eating it for a short period of time. If you're the importer, you may be eating it for a short period of time. But that's an unsustainable business model. And you've got your shareholders and you've got your banks and you've got your debt covenants, and you have to abide by all of the restrictions that you have. So ultimately, you're going to be forced to pass those tariffs down into the system. And unfortunately, the consumer is going to eat them. And I think yesterday's numbers gave us a little hint. And by the way, I never get too excited over one set of numbers. I always warn people, it's a set of numbers. It could be completely different next month. So we have to wait to see what the trend is. But when you see, things that we know we're importing, like toys, like appliances, like paper products, all showing close to 2% inflationary pressures, we have a pretty good idea that the underlying product is probably not going up.
But the Journal doesn't even argue that the problem is inflation, because it says it's probably a one-shot deal, doesn't necessarily go into services, doesn't necessarily... But it is a tax. It is a tax, and when you tax something, you get less of it, usually.
Well, when you tax something, you get less of it. And
it costs someone somewhere.
You affect people's buying power.
Yeah.
And if you're on a fixed income, you have less disposable income to buy goods because
and they're regressive.
Those goods are more expensive. And we're therefore affecting the part of the population we least want to affect.
Exactly.
Which is the hardest working individuals. It's a very regressive tax that will force people to choose between what they're able to buy, what food can they put on their table, what can they do to improve their home or not. You're forcing consumers to make very difficult decisions as this gets passed along.
Here's the question. I think I was concerned in part because so many CEOs would come on and say they were concerned about the uncertainty of taxes and that the uncertainty was going to prevent them from making investments. The things that they wanted to do, they were going to sit on their hands and try to figure out what was going to happen, and then they'd wait. It does not appear, at least the way the economy is going thus far, unless it's, you know, we don't know the other side of it, that somehow people are stopping. You look at all of the AI investments that are taking place. You look at all, I mean, there's just even some of the M&A activity that your former firm Goldman Sachs is reporting. I mean,
Johnson & Johnson was on this morning talking about $55 billion in investments.
Look, maybe there'd be even a greater tidal wave of investment if this uncertainty didn't exist. But how do you think about that?
The uncertainty piece that we've all been talking about. So look, the uncertainty piece breaks down into a bunch of different silos. So we had the one big, beautiful bill uncertainty piece. Now, the bigger uncertainty in that bill was really what was going to happen to the personal income taxes. The vast majority of the corporate taxes were law. They were not going to expire at the end of this year. Right. But on the flip side, there were about $4.5 trillion of tax relief on the individual side, meaning that every taxpayer's rates would go up. Yes, we would bring back the standard deductions, we would bring back the itemized deduction, we would bring back all the complexity of filing tax returns. And I think that had a highly, a huge effect on the way people were thinking about what their after-tax spending would have been or could have been if Congress was not able to roll those rates forward. Not only did they roll those rates forward, they actually put back some of the stimulative for lower income families that was in the original bill, which I think are very good and supportive. There's enhanced child care credits. There's enhanced credits for families. So look, we end up in a place from the tax standpoint, from the income tax standpoint, where I think that variable is off the table. We know what it is. It's baked. It's signed. Nothing's going to change, and people cannot say, I don't understand what's going on with taxes at this point. And in fact, on the business side, there was more incentive in there to go out and manufacture and build in the United States. You got enhanced depreciation. You got enhanced R&D credits. Right. So all of the things that you would want or need to manufacture and build in the United States were included in the tax bill. So now we get to the point where I think we were starting with Joe is, okay, if I'm going to go build and I'm going to manufacture in the United States, okay, I'm starting maybe to understand the cost of manufacturing the facility. Once I manufacture a facility, I've got two inputs. I've got to bring labor into the facility, right, and I'm not sure what my labor costs are going to be. And I have to bring raw materials into the facility. And a lot of those raw materials are not manufactured here in the United States. And even if we say we will manufacture those here in the United States, realistically, that's a 5+ year project. And what we're seeing on some of these deals where we're making deals to manufacturing things in the United States, like magnets, the price is dramatically different than where the current clearing price of a magnet is today. Right. So am I going to build a factory? Am I going to
Do you think these announcements aren't real then?
Things are real, but the question, am I going to go borrow $1 billion plus to build a factory if one of my major input costs just doubled? Right. So you have to assume my final good has to sell for dramatically higher.
Or you have to figure that it's cheaper still to manufacture it here, given the tariffs that are going to be imposed on anything you manufacture.
You have to make that rule. So you have to make that adjustment in your mind, but knowing that manufacturing takes 5 years forward from now,
you don't know
and predicting what the tariff is when it's not law.
Right.
When it's not been law, it's not gone through the Congress. That's a tough thing. As a board of a director, as a board would sit there and say, is this a prudent thing to do for our shareholders?
Does the market make sense at these highs? Do you think that momentum can continue? Because we've had a lot of people over the last few days who say, hey, the market can grow into this and continue to push even higher.
Well, right now we are seeing the vast majority of spending in what I would call the AI-related and ancillary spaces. We're seeing it in the power grid, power formation, power generation. We're seeing it in the warehousing of CPUs, GPUs. We're seeing it in the building of these massive buildings. So look, the AI wave right now and the demand for compute power is extraordinary. and it's really important in the U.S. economy. And that piece of sort of demand itself, which seems insatiable at this point, it seems like we cannot build enough data centers fast enough, which we can talk about at some other point, because we've never seen a period in time where we don't overbuild at the end. That demand for AI infrastructure today is having a dramatic impact on sort of the construction market, on the labor market, on the goods and services that need to go in to continue to build out that industry, which will be very important for the United States.
Gary, so I'm still back to this. So it's not necessarily inflationary, but it is a tax. So would you cut? Right? I mean, taxes are, they cause a slowdown, and if it's not inflationary, do you think that Trump's on to something with the cut, or do you think the Fed's in the right position right now?
So look, when you talk about the inflationary side, there's always an argument here. If you take a product that cost X and put a 100% tariff on it, it now costs 2X.
Yeah.
But you only do it once. There's a price change. Okay?
Price change, but not inflation.
Price change. It's not going up month after month after month after month.
Right.
So the way inflation data is calculated, we could argue if this is right, you will see a bump in 1 month. But the next month, there will be no inflation in that product.
So yes, you'd cut?
So there will be no inflation in that product. So you have to understand the price of the good and the amount of disposable income that people would have would go down. It would go down because they'd be paying the higher price.
Right.
So when you get to the Fed and you get to the Fed policy, I think ultimately you're looking at data. You're looking at inflation. I mean, they've got their dual mandate. They have a very clear dual mandate, which is, stable prices. We interpret stable prices to be 2% inflation, right, and we look at full employment. Right now, one could argue that we are at stable prices. Yeah. You could argue that they were more stable 2 days ago before we got yesterday's data. Right. We'll get a little bit more data today. But still, even with yesterday's data and CPI 2.7%, like I said, it's one number. We were 2.4% before that. And we see the employment numbers continue to be relatively strong. It feels like there is a decent argument to be made on either side of the equation.
I could debate either side.
I think there's a decent argument. Now, look, no one's asking me, but if someone said, what would you personally do, Gary? I'd probably lower interest rates a little bit. I'd lower them 25 basis points.
I'm with you.
And see what happens. I don't think there's a lot of risk to lowering rates at this point, 25 basis points. But again, we're lowering the front end of the curve. The front end of the curve right now is relatively low. There's more demand for short-term treasuries.
Long end looks okay, though.
The long end's going to trade where the long end trades.